Congratulations! You found the Sandu Pirls Stock Market Commentary for market week ending Friday, December 12th, 2014. Market breadth. With this past week's market decline, our bull-bear point-and-figure ratio fell from 0.95 to 0.66, declining further into bearish territory. The total count of securities in bullish or bearish patterns rose 3% to 2,701. The count of bearish stocks increased 21%, while the count of stocks in bullish patterns decreased 16%. The Sandu Pirls P&F Market Breadth Summary Chart shows us a market now 2 consecutive weeks in bearish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, and clicking Sign Up. For those who are interested, a free 2-week trial subscription is available. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 92 points for the third decline in 8 weeks. At a positive 81 points, it continues below all 9 tops above plus 100 and above all 7 bottoms below minus 100 in the last 3 years. Market Gauge Volume Analysis. In this week's volume analysis, all indexes ended in neither accumulation nor distribution mode. In the last 2 weeks, the Nasdaq 100 Trust had 0 accumulation days and 0 distribution days. Of the other indexes, both the Diamonds Trust and the S&P 500 Deposit Receipts ended in neither accumulation nor distribution mode. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week also, the Nasdaq 100 Trust ended in neither accumulation nor distribution mode. Momentum. At minus 115.52, the CCI 20 daily has 3 days below zero, and below minus 50 is outside the range for a valid zero-line reject entry signal. The pattern we see is a near-perfect Shamu pattern. However, this is a counter-trend signal and is beyond the scope of our basic Woody's CCI signal analysis. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 23 weeks ago, while the daily CCI 20 began a Woody's uptrend 6 weeks ago. At plus 91.36, the CCI 20 weekly in a Woody's uptrend remains outside the plus or minus 50 range for a valid zero-line reject. Industry rotation the last 2 weeks. Only 2 of the top 5 industries are positive, and all of the bottom 5 are negative. Bullish, brokers, and disk drives continue in the top 5. REITs has entered the top 5. Oil services, oil, and gold and silver continue in the bottom 5. Bearish, semis has left the top 5. Focus this week from www.mindonmoney.wordpress.com. 3 conditions and 3 warning signs. How to tell if the next financial crisis is upon us. The following are a few key points excerpted from the article. The rapid collapse in oil prices might have set up a repeat of the 2008 financial crisis. Before we all run for the bunkers and the freeze-dried food, we should know the conditions needed for a crisis to happen, and the signposts we'll see if the crisis gets going. For a sector correction to become a meltdown, and for that to turn into a global crisis, several preconditions need to be in place. The first condition is a serious market sector correction. According to some participants in the market for energy company bonds and loans, such a correction is already underway and heading toward a meltdown. The second condition, a spiral of distressed sales of bonds and loans. The third condition, which we can't determine directly, would be pressure on credit default swap dealers or hedge funds to make deposits as the prices of the CDS move against them. The unknown is how much of the $2.77 trillion of junk CDS on bank balance sheets on June 30th this year was energy related. If history is any indicator, the CDS in the distressed energy sector already far outweighs its 18% share of the junk bond market. A third sign to look for would be the rumors or news that the big investment-grade energy companies are having trouble renewing their commercial paper, bank loans, or maturing bonds, the ExxonMobils and Shells of the world. If we see all these signs in a matter of days or weeks, then our global financial system is being tested once again by the small community of speculators that profit from betting against industries, countries, or markets. They made a fortune betting against mortgages. Most of them didn't retire to enjoy that wealth. They moved on to the next trade, and every day they try to repeat their investing success. Do we need to remind ourselves that Fannie and Freddie were the ExxonMobil and Shell of the mortgage business? Or that no target is too big if trillions of dollars can be used to make the bets? So where will the next trade be? Anywhere there might be weakness. Thank you for tuning in for this week's Sand to Pearls Stock Market Commentary, compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend without too much Christmas shopping pressure, that you have a great week coming up, and wishing you true success.